Only a handful of trading days left in 2023, and on this week's Fastest 4 Minutes in Finance, we're looking at the probability of another Santa Claus rally for stocks. Hello again, I'm Scott Inman. Well, we already had a turkey rally for stocks. The S&P 500 index was up almost 9% in November. That even surprised me. It ranks as the 18th best month in the past 73 years. So does that make it more or less likely that we have a Santa Claus rally? Well, let's start with historical December performance in general. Since 1950, December is the third best performing month, but Santa has not delivered in more recent history. Take a look at this chart from our partners at LPL Research. It shows the average S&P 500 returns per month since 1950 over the past 20 years, 10 years, and 5 years. You can see on the far right in the highlighted box that December has been strong over the longer terms, but negative over the past 10 years and 5 years. Now that number is dragged down considerably by 2018 when the index lost more than 9% in the face of rising interest rates. Still, the Santa Claus rally got its name for a reason. Historically, it has been nearly as reliable as old St. Nick himself leaving gifts under the tree. Take a look at this chart. This one shows the percentage of positive returns per month since 1950. December has been positive 74% of the time. That's the highest probability of any month, with April close behind. Let's break it down even more. This chart shows that just like the kids have to be patient for Christmas to arrive, the Santa Claus rally usually arrives on time as well. Since 1950, the second half of December has been stronger than the first half. The first half is negative on average over the past 20, 10, and 5 years, but positive or flat in the second half. December on average is not as strong when it follows a positive November. The final month of the year is up on average only 0.83% when November is positive versus 2.78% when November is negative. Bottom line though, what happens over the next 2 weeks should not make or break your Christmas, and it shouldn't make or break your investment strategy. History also shows us that a turkey rally like we just experienced can be a good sign for stocks in the new year. We've got one more chart to show you. Since 1950, there have been 31 times when the S&P 500 was up more than 8% in a single month. The average return 1 year later, almost 16%. That's a big difference from the other 859 times that the index returned less than 8%. The average return 12 months later in that scenario is 8.7%. This suggests that a big month often signals longer-term strength in the market. Now, that's not to say there aren't headwinds. Each year has its own economic uniqueness, but there is history to support that 2024 could be a good year for stocks. As always, staying invested in stocks to reach your long-term goals is a much better strategy than trying to find the perfect time to jump in or jump out. Thanks for watching.